Welcome back to Theta Fuse Radio Special Holiday Edition for July 4, 2025. You are listening to The Deep Dive, and today we're not just looking at numbers, we are stepping right into the earnings season war room for Q2 2025. Our mission, well, it's to cut through all that noise, the endless corporate reports, and really extract the crucial nuggets of knowledge. We want to arm you with what those figures and, importantly, those management statements truly mean for the broader market and, for your own financial landscape. We're going to be focusing pretty heavily on the upcoming reports from banking giants like JPMorgan Chase and Citigroup, because let's be honest, they're some of the most significant bellwethers out there. They really signal the economic currents we all need to navigate.
And that's a really critical point. Even though it's July 4th today, maybe a day off for some folks, the insights we get from this upcoming earnings season are just vital. Even if you're not hitting the buy or sell button today, this period, it's much more than just stock prices. It's like a real-time pulse check on the whole economy's health. Earnings reports, they're like X-rays, really. They show corporate performance, consumer behavior patterns, those underlying investment trends that shape our financial world. Think of this deep dive as, well, your shortcut to being really well-informed. You grasp the market's direction without drowning in dense financial docs yourself. And just to set the stage here, analysts at FactSet, the U.S. financial data group, they put out a preliminary number. They estimate a year-over-year earnings growth rate of 5.0% for the S&P 500 companies for Q2 2025. Now, what's striking about that, maybe a little concerning, is that 5.0%, that would actually mark the lowest earnings growth reported by the index since way back in Q4 2023. So, as we head into this season, the backdrop suggests maybe a notable moderation in overall growth, which kind of makes the individual company stories even more fascinating to watch.
Okay, yeah, that 5.0% S&P forecast being the lowest in, 6 quarters, that really jumps out. And I bet you're wondering, like I am, how do we square that modest overall growth with some companies just absolutely crushing it? Sounds like a bit of a mismatch. So to get the full picture, we need our war room map, the Q2 2025 U.S. earnings calendar. Today's July 4th, sure, fireworks and all that, but the real market action, the fireworks there, you're about to kick off next week. It's going to be interesting.
Precisely. The official start for Q2 earnings is really the second full week of July. And kind of traditionally, the big banks lead the charge. We're talking giants like JPMorgan Chase, that's JPM, Citigroup, ticker C, and Wells Fargo, WFC. All three of them are lined up to report pre-market open, PMO, that's Tuesday, July 15th. PMO means, before the opening bell. So their results, they hit the tape early and really set the tone for the trading day. It's not random scheduling. It's a deliberate kickoff. These companies, their health is just so deeply tied into the whole economic system.
Absolutely. And it's not just those three opening the gates, is it? That whole week is just packed with financial heavy hitters. Gives us an early look at the system's health. So Tuesday, July 15th, like you said, Citi, JPMorgan, Wells Fargo, all PMO. Then bam, Wednesday, July 16th, also pre-market open. Bank of America, BAC, Goldman Sachs, GS, Morgan Stanley, Ameska. It's just this flood of crucial financial data hitting right at the start. Now, why are these guys, these financial bellwethers, why are they so uniquely important to watch? Especially thinking big picture, because their results aren't just about them, right? They give us those early vital signals about credit health, consumer spending patterns, the whole environment. They're kind of like the arteries of the financial system. Their pulse tells us a lot about the whole body. Any stress or strength, it ripples out.
You've really hit the nail on the head there. It's exactly why we focus on them so much. I mean, their loan books show how consumers are doing, borrowing, spending. Investment banking shows deal-making activity. Trading desks show market confidence. It's a holistic view. And while we're right on the edge of Q2 earnings, it's actually really valuable to glance back at some reports that just finished up in late June. These sort of pre-Q2 reports give us a mixed picture across different sectors, some context, some early signs for the wave that's about to hit. And we've seen some really exceptional financial performances, some really strong growth stories already.
Yeah, I'm eager to get into some of those early results. Where are we seeing that explosive growth that might, push back against that 5.0% S&P number?
Okay, let's start with one that just, blew past expectations. Gives us a fascinating read on consumer spending. Carnival Corporation, CCL, their Q2 2025 report, they announced, get this, record revenues for the 8th consecutive quarter. That's just amazing consistency, especially for a sector hit so hard just a few years back. Their EBITDA, that's earnings before interest, taxes, depreciation, amortization, a key cash flow measure up a huge huge 26%. Operating income up 67% year over year. And what's really stunning, their net income more than tripled. It beat their own guidance by $185 million. That's significant. Plus, customer deposits hit an all-time high. That signals strong future bookings, right? Revenue was $6.33 billion versus estimates of $6.21 billion, a solid beat. EPS, $0.24 estimate. That's almost a 46% beat on earnings per share. This isn't just demand. It's a company that's clearly figured out operations and pricing power post-pandemic.
8 straight quarters of record revenue for Carnival. That's phenomenal. So in a world where spending can be choppy, inflation's still kind of lurking, what are they doing right? What specific strategies or, market conditions are letting them consistently blow past expectations like this? Is it new customers? Better cost control? What's the secret sauce?
It's really a mix of things. It's kind of their own win now approach, if you will. First, there's pent-up demand for experiences. People want travel, and cruises offer, a good value package. Second, Carnival's gotten incredibly good at managing revenue, optimizing pricing, onboard spending. They're seeing strong demand for the higher-end cabins, the extras. And third, yes, absolutely, there's strong cost discipline, operational efficiency across the fleet. They're using tech to streamline things, and that flows right to that impressive EBITDA growth. It just shows, even in traditional industries, smart execution drives serious growth.
That makes sense. That operational win-now angle really connects the dots. Okay, so travel's strong, but the AI story, that continues to be huge. What early signals are we seeing there?
Oh, absolutely right. To pivot to AI, it's arguably one of the strongest themes, the biggest tailwinds in the market right now. Look at Micron, MU. Their Q3 2025 report, they hit record revenue of $9.3 billion. That's up 15% just from the prior quarter, and a massive 37% year-over-year jump. Both their gross margin and EPS beat guidance too, which always signals efficient operations. But what's maybe even more telling for the future, and a key insight for us, is they actually raised their outlook for DRAM demand for calendar 2025. They bumped it from mid-teens percentage growth up to high teens. And DRAM, that memory, is crucial for computing. They said directly it was driven by robust AI and data center growth. Their revenue beat estimates by over 5%, $9.3 billion versus $8.85 billion. EPS $1.91 versus $1.61 test. Almost a 19% beat. This isn't just one strong quarter. It shows how directly AI investment is fueling this massive demand for the actual hardware.
Okay, Micron's numbers definitely show that AI tailwind is real. But for a lot of people, AI still feels kind of abstract. Can you give us a sense of how directly those investments turn into Micron's revenue? And are there any, challenges still, even with this crazy growth? How does AI affect a chip maker so much?
Excellent question. It bridges that gap between the AI buzz and the actual corporate results. For Micron, it's incredibly direct. Think about it. Every major AI application, like those large language models, advanced data analytics, they need huge amounts of high bandwidth memory, HBM, to process all that data fast. So as companies pour billions into building AI infrastructure, those giant data centers packed with AI servers, the demand for Micron's specialized DRAM and NAND flash memory just explodes. It's not just more servers, it's servers stuffed with more and much more powerful memory. That's Micron's bread and butter. The challenges. Well, even with this growth, managing supply chains is complex, scaling production fast enough without overbuilding. And of course, competition is always there. But right now, that demand side from AI is just the dominant force for them.
Got it. So AI is a huge engine. What about professional services? Are companies like Accenture seeing a direct boost from all this AI spending too?
They absolutely are. Accenture, ACN, their Q3 2025 report really highlights this perfectly. They reported revenue of $17.7 billion. That beat their guidance, grew 7% in local currency. Their operating margin expanded 40 basis points, that's 0.4%, shows better efficiency, and EPS grew 12% year over year. But here's the kicker, directly answering your question. They had strong bookings of $19.7 billion overall. And a significant chunk, $1.5 billion, came directly from Gen AI services, generative AI. Their revenue beat by over 2%, EPS beat by over 5%. This shows how these big consulting and services firms are now crucial partners for businesses trying to actually use AI, integrating it, managing data, transforming infrastructure. They're the ones enabling the AI revolution for lots of companies, and their bookings reflect that hunger for AI implementation.
That's a great point, how AI spreads beyond just the chip guys. But for a real economic pulse check, we need those traditional industries too, right? The ones underpinning daily life. What are the early signs there?
Exactly. It's not all shiny new tech or fancy trips. We need to check the pulse of sectors that reflect core economic activity. Take FedEx, FDX, for example, their Q4 2025. They grew adjusted operating income by 8%, expanded adjusted operating margins by 60 basis points, and crucially, they delivered on that big $2.2 billion structural cost reduction plan for their fiscal 25. That plan, it's about long-term efficiency, making operations leaner regardless of how much stuff they're shipping. Their revenue came in slightly ahead at $22.2 billion versus $21.83 billion estimate. EPS $6.07 versus $5.86 estimate, a decent beat. This shows really strong execution on cost control in what's still a tough logistics market. Suggests maybe companies are prioritizing efficiency in a potentially tighter economy.
Cost management, yeah, that seems to be a recurring theme. And what about consumer discretionary stuff beyond travel? Like, how's the average person spending on everyday things like eating out?
That's where Darden Restaurants DRI gives us a pretty compelling story from their Q4 2025. They own Olive Garden, Longhorn Steakhouse, others. They reported same restaurant sales growth of 4.6%. Total sales hit $3.3 billion, up over 10% year over year. And for the first time, they crossed $12 billion in total sales for their fiscal year. Big milestone. Revenue was $3.27 billion, just edging out the $3.26 billion estimate. EPS 2.98, also just a hair above the $2.97 estimate. Basically right on target, but showing solid growth. This points to pretty resilient consumer spending in dining. Suggests people are still willing to spend on eating out, maybe especially at established chains perceived as good value. It's a positive signal for hospitality.
Okay, so strong growth spots in AI, travel, even dining. That's encouraging. But it's not just the numbers, right? It's also about strategy, innovation, companies evolving.
Precisely. Strategy is key. Look at Nike, NKE, in their Q4 2025. They're really pushing these win now actions, focusing on 5 things: culture, product, marketing, marketplace, and what they call the ground game, that ground game bit. That's about their direct-to-consumer efforts, boosting their own stores, their digital channels, connecting directly with people. And they said they're already seeing positive momentum in running and basketball products. Their revenue came in at $11.1 billion versus a $10.72 billion estimate, a nice 3.5% beat. EPS is $0.14 versus $0.12 estimate, a solid beat there too. It shows they're being proactive, trying multiple things to reignite growth and adapt to how people shop now.
Nike's Win Now strategy, it sounds pretty comprehensive. Can you break down what those 5 areas actually do for their business? Like, how does ground game give them an edge against newer, maybe faster rivals? Tell us about athletic retail's future.
Great question. Win Now is all about regaining that market leadership mojo in a super competitive space. Culture is about making the brand cool again. Product is innovation, making stuff people want. Marketing is cutting through the noise. Marketplace is selling smartly through partners or their own channels. Now, that ground game piece is vital. It's about building deeper connections directly with you, the consumer, through their own stores, their apps, local events. This lets them control the whole brand experience, get direct customer data, offer personalized stuff, and importantly, avoid the heavy discounting that can hurt the brand. Against those newer agile disruptors, Nike's scale plus that direct connection becomes their advantage. It tells us the future of athletic retail is definitely more personalized, more experiential, and deeply tied into digital.
Makes sense. Established brands adapting. And it's not just the giants making moves, right? Fintech is always changing fast.
Oh, yeah. Robinhood, H-Hood is an interesting one. They're expanding way beyond just being the entry point for new investors. They successfully rolled out their crypto offerings to 31 countries across the EU and EEA. That's a big global push. They also introduced things like perpetual futures and stock tokens, plus more advanced tools like better charting for the serious traders. Perpetual futures, they're complex derivatives, let you bet on price without an expiry date. Stock tokens are like digital shares, allow fractional ownership, global trading. Their CEO, Vlad Tenev, he laid out this vision, become the leading platform for active traders. So diversifying beyond just the beginner crowd. It shows they're focused on global growth, broadening their products, and attracting maybe a more engaged, higher value customer.
Sounds like they're really evolving their model. Okay, what about healthcare? Always huge innovation there, especially with those blockbuster weight loss and diabetes drugs we keep hearing about.
Healthcare is absolutely buzzing, especially, cardiometabolic health. Eli Lilly, LLY, has a stunningly strong pipeline, particularly with something called orforglipron. That's an oral GLP-1 agonist and other promising candidates too. GLP-1 agonists, they're that class of drugs revolutionizing diabetes and weight loss. The big deal with an oral one like orforglipron, much more convenient than injections, could reach a vast number of patients. Similarly, Novo Nordisk and VO, they have a powerhouse pipeline in diabetes and obesity, and they're already the leader in GLP-1 diabetes with drugs like Ozempic and Wegovy. These companies, Lilly and Novo, they are right at the forefront of a massive shift in pharma.
Incredible progress, really, with huge market implications. Are there other, maybe more niche, but still groundbreaking things happening, like cell therapies?
That brings us neatly to Vertex Pharmaceuticals, VRTX. They had some truly remarkable news about zimislecel. This is an islet cell therapy targeting type 1 diabetes, T1D. That's the autoimmune kind where the body attacks insulin-producing cells. Their study showed really significant improvements in blood sugar control. All 12 participants saw a positive impact, often need of much less or even no external insulin. This points towards a potential cure, or at least a functional cure for T1D, moving way beyond just managing it. So advancements from Lilly, Novo, Vertex, they aren't just small steps. They're redefining treatments, creating potentially huge new markets. That's where some serious growth is coming from in healthcare.
Wow. Yeah, some really powerful growth stories and strategic plays there. But okay, the market isn't always perfect, right? We had that FactSet number, 5.0% S&P growth, lowest since Q4 23. Were there any companies that maybe slightly underperformed estimates recently, hinting at maybe some softness underneath all that strength?
Yes, definitely important to see the whole picture. We did see a few instances of slight misses, mainly on the revenue line, though sometimes they still beat on EPS, which often points to good cost control. For instance, Constellation Brands, STZ, the beverage company, their Q1 2026 report. Revenue was $2.52 billion versus an estimated $2.56 billion. So a small 1.76% miss. EPS was $3.22 versus $3.29 estimate. Also a slight miss. Now, they did maintain their full-year outlook for beer, showing confidence. But, it raises slight questions about spending on premium drinks. Similarly, Kroger, KR, the grocery giant, Q1 2025, revenue $45.12 billion versus $45.31 billion estimate. Tiny miss, less than 0.5%, but their EPS actually beat. $1.49 versus $1.46 estimate. Suggests maybe people are watching their grocery budgets a bit, but Kroger's managing costs well to protect profits.
Right, and there were others too, like General Mills and Paychex, also showing kind of flattish revenue versus estimates, even if EPS held up.
Exactly. General Mills, GIS, Q4 2025, revenue miss under 1%. EPSB, Paychex, PAYX, Q4 2025, revenue basically flat, EPS exactly met estimates. So yeah, it paints a picture of some areas maybe seeing demand moderate slightly, but companies are often compensating through efficiency.
Okay, so we have this really fascinating kind of mixed bag, don't we? Some companies absolutely smashing it, AI, travel, innovation driving them, others hitting targets, maybe slightly missing but holding steady, often through cost cuts. Now the big question, what does this mixed performance plus that FactSet S&P forecast of 5.0% growth lowest since Q4 23? What does it all tell us about the market's volatility setup heading into the main Q2 earnings wave? Are we bracing for a storm or just, some choppy waters?
That is the million-dollar question, isn't it? And understanding this divergence, this split picture, is absolutely the key to figuring out the market's volatility setup. So yes, that aggregate S&P 500 growth rate, 5.0%, it does look modest. But underneath that average, the individual reports we just talked about show these incredibly powerful pockets of strength driven by very specific, really impactful trends like AI and data centers, right? Or those huge breakthroughs in obesity and diabetes drugs. And it's also about smart strategy, like Carnival's execution or Nike's win now push. This divergence itself is a recipe for volatility. Think about it. If some parts of the market are booming while others are just treading water or even sinking slightly, investors are going to constantly shift their focus, right? Pulling money out of the lukewarm areas and piling into the hot spots. This rotation, this constant shifting of capital between sectors and stocks based on performance and outlook, that creates churn. It leads to sector-specific rallies and declines, not just one smooth market move. That means more overall choppiness, more volatility.
Okay, so not a uniform tide lifting all boats, but more like a choppy sea. Some ships catching strong winds, others maybe struggling. That makes sense. And that brings us right back to those banks reporting next week. JPM, Citi Wells Fargo on July 15th. How exactly do they fit into this volatility setup? And what specifics, beyond just the headline beat or miss, should we really be watching for in their reports? Because they're complex, I imagine.
They are absolutely critical, precisely because these banks are such direct proxies for the wider economy. Their earnings. They give us some of the first and some of the broadest insights into how consumers are really spending, how much businesses are investing, and just the overall stability of the financial plumbing. So any big surprises from them, surprisingly good or unexpectedly bad, could easily trigger major market reactions, not just in bank stocks, but across the board. Now, beyond those headline revenue and net income numbers, which obviously grab attention, you really need to dig into several key metrics hidden deeper in their reports. First, net interest margin, NIM. Basically, how well are they making money from lending? It's the difference between the interest they earn on loans and what they pay out on deposits. A healthy NIM is good. A shrinking one might signal pressure.
Okay, NIM, got it. What else?
Second, loan growth and quality. Are businesses and people actually borrowing more? And crucially, are they paying it back? You need to watch for any increase in non-performing loans going bad. Or look at the provisions for credit losses that's money banks set aside because they think some loans won't get repaid. Slowing loan growth plus rising bad loans. That's a potential red flag for the economy.
Makes sense. Loan quality is key. What's number 3?
Third, trading revenue. How did their big Wall Street trading desks do? This reflects market activity, volatility, investor risk appetite. Strong trading can boost earnings, but you want to see if it's sustainable.
Okay. And number 4?
Fourth, investment banking fees. This tells you about corporate deal-making, M&A, IPOs, that sort of thing. A jump here often means businesses are confident in making big moves.
Right, the deal pipeline. And you said guidance is maybe the most important.
Absolutely. Perhaps most crucial is their guidance. What are the bank executives projecting for the rest of 2025? Their outlook for loan growth, credit quality, the economy. That forward-looking view often moves the stock price more than the past quarter's results. It's what the market really focuses on.
That's a fantastic checklist. NIM, loan growth and quality, trading, IB fees, and especially guidance. Like deciphering their battle plans on the war room map. And this isn't just about banks, is it? These results, they send ripples everywhere. How does this extend into other big sectors? Thinking about the calendar and those recent reports we covered, what other fronts should we be watching?
Oh, the ripple effects are huge. Once the banks kind of set that initial tone, attention shifts fast to other key sectors, each with its own story. First up usually is the tech sector. They report mostly late July, early August. Think Netflix on July 18th, Tesla on the 23rd, then Microsoft Alphabet on the 30th, Apple, Amazon later on August 8th, all the big guns. The key question there, will those strong AI narratives from Marvell and Micron really carry through to the giants? Is AI spending translating into massive revenue and profit for cloud services, software devices? Any weakness there, or maybe a slowdown in cloud spending could really dampen that AI enthusiasm. Continued strength, that fuels the market.
So AI is definitely center stage for tech. What about healthcare, given those amazing drug developments we talked about?
Exactly. Healthcare innovation is still a massive theme, especially obesity and diabetes drugs. Lilly, Novo Nordisk, Amgen, Vertex, huge excitement there. Their Q2 reports will be coned for updates, clinical trial results, regulatory news, how quickly they can actually make these drugs, more breakthroughs, positive guidance on access that could totally reshape the pharma world and create new leaders. Watch production capacity updates, that's really key.
And the everyday consumer. We saw that mixed picture, strong Darden, but maybe softer Constellation brands, Kroger. How does that play out for staples, coffee, fast food?
Yeah, consumer sentiment is still really tricky to read. That mixed bag highlights varied behavior. People might splurge on experiences like dining out, but maybe cut back on packaged goods or trade down. So we'll watch companies like PepsiCo. They report July 17th, Coca-Cola on the 22nd, Starbucks on July 30th, McDonald's August 4th. Very closely. Their reports will show if that selective spending continues, how inflation's hitting their costs, how different income groups are behaving. Are they trading down, still paying for premium?
And finally, can't forget the energy majors. Exxon and Chevron report early August. What's the story there?
Right, ExxonMobil and Chevron reporting August 1st. Vital signs for energy markets and industry. They've talked about financial returns, growth, Exxon projecting like 10% annual earnings growth through 2030. So their Q2 results, and especially their outlooks, are key. How are they balancing investing in new projects, including lower carbon stuff, with returning cash to shareholders? What's the outlook for global energy demand and prices, their spending plans, their CapEx? That tells you a lot about their long-term confidence, too.
This really drives home that you need to understand these specific drivers, these industry nuances, right? Not just react to headlines. This kind of deep dive helps you anticipate moves, see where the real strength or weakness lies. It's like getting intel from all corners.
And that's exactly why critical thinking is so important when these reports hit the wire. It's not just, did they beat or miss estimates? You got to dig deeper. What's the quality of the earnings? Was the beat from real operational strength or like a one-off gain? Is revenue growth sustainable? And just as vital, what are the management comments telling you about the future? Are they confident, cautious? Signaling strategy shifts, that forward look, listening to their tone on outlooks, headwinds. That's where the real edge is for making informed decisions.
Okay, that was a fantastic breakdown of what's coming and what to watch for. Really paints a picture of a market that's, well, complex, driven by specific trends and how well companies execute. And speaking of watching things, we got a great question from one of you, our listeners, that ties right into this, especially that initial fact set number. Here it is. Given FactSet's forecast for the S&P 500's lowest earnings growth since Q4 2023, should I be concerned about a broader market slowdown, even with some companies reporting strong individual results?
That is an excellent, very sharp question. It gets right to the core of what's confusing people right now, I think. So let's tackle it head on. Okay, FactSet's projection, 5.0% S&P 500 earnings growth for Q2. And yes, that would be the lowest since Q4 2023. So on the surface, yeah, it might make you think, oh, broad slowdown coming. Aha. But, and this is really crucial, remember, the S&P 500 is just a big average, right? 500 companies. Averages can hide a lot of variation underneath. Think of it like a classroom average grade. If half the kids get A's and half get C's, the average might be a B, but that doesn't tell you about the A students or the C students, does it? The recent earnings we just discussed, they clearly showed that divergence. It's not a uniform slowdown at all. We talked about Carnival, right? Record revenues for the 8th quarter in a row, net income tripled. That's not slowdown territory. That's booming, driven by specific trends and good management. Or Micron, record revenue, raised outlook, fueled by AI demand. That's explosive growth in their specific area, directly pushing against a weak average. Even Nike, with their Win Now plan, seeing positive signs in key areas, even if other consumer bits are softer. These examples, they're strong proof of individual company strength, positive momentum, that are kind of counteracting that weaker overall average growth rate.
So the average doesn't tell the whole story.
Exactly. So while that 5.0% forecast suggests, yeah, maybe the overall pace of growth has moderated compared to before, it doesn't automatically mean a broad market collapse or some deep recession across every single sector. What it does suggest very strongly is a market where individual company performance, sector-specific trends, those are going to be absolutely critical, paramount. Your focus as someone trying to understand this should be on digging into those details. Where is the real strength? Where are the opportunities? Not just getting spooked by one headline number for the whole index. And, you know, the upcoming Q2 season, especially when Microsoft, Alphabet, Apple, Amazon report later in July and August, their results will be huge in shaping that overall S&P story. Their sheer size means their performance could really move that 5.0% average up or down. If they keep showing strong AI growth or resilient spending, the picture could brighten. If they stumble, that could drag the average down. So bottom line, look past the average. Analyze the underlying forces in different sectors and specific companies. That's where the insights are.
It's a fantastic perspective on divergence. Really shifts the focus to where growth is happening and maybe where weaknesses are hiding. Earnings season, it's not just numbers, is it? It's like this dynamic puzzle revealing the economy piece by piece. A test of strategy. We hope we've equipped you with a look at the calendar, some context from recent reports to help you put that puzzle together. It's definitely a lot to process. Which reminds me, for all the traders maybe glued to their screens, here's hoping this holiday weekend means they're finally touching some grass today.
Maybe so. And, you know, as we all kind of sift through this complex picture of corporate performance in the coming weeks, here's something to think about. Beyond just the financial figures, what one strategic insight, maybe something you hear on a management call or a new product launch that catches your eye, what single thing do you believe really holds the key to a particular company's success this quarter? Think about that underlying narrative, that competitive edge that's truly driving where they're headed. It's often more revealing than the numbers alone. And of course, please remember, the value of your investments and the income derived from them may go down as well as up. You may not get back all the money that you invest. The value of international investments may be affected by currency fluctuations, which might reduce their value in sterling. Our most held investments should not be taken as a personal recommendation to buy or sell a particular stock.
Excellent point. Thank you so much for joining us for this deep dive into the Q2 2025 earnings season war room. Make sure you subscribe to the deep dive on Spotify and YouTube so you don't miss our future insights. We'll be back soon with more deep dives into the financial landscape.